Hello guys, this is Shweb Yaqub. In today's session, we will discuss the first OT case of March-June 2019 attempt question. Let's start with the scenario. Tulip company is a large company with an equity beta of 1.05. Company plans to expand existing business by acquiring a new factory at a cost of $20 million. Finance for the expansion will be raised from an issue of 3% loan notes issued at a nominal value of $100. These loan notes will be redeemed after 5 years at a nominal value or convertible at that time into ordinary shares in Tulip company with the value expected to 115 per loan note. So this is the conversion value at the end of year 5 is given. The risk-free rate is 2.5, equity risk premium is 7.8. Company is seeking additional finance and is considering using Islamic finance, and in particular would require a form which would be similar to equity financing. If you remember from the Islamic finance, Mudarba is a kind of finance that is equivalent to the equity financing. So let's move to the first question. What is the cost of equity of Tulip company using the capital asset pricing model? If you remember the formula, risk-free rate plus beta 1.05 into equity risk premium, and that is equal to 7.8 into 1.05 plus 2.5, that is 10.69. So B is the correct answer. Using the estimate of 5% and 6%, what is the cost of debt of the convertible loan notes? So let's make a pro forma. Year 0, 1 to 5, 5. Cash flow. In year 0, market value is, that is equal to issued at 100, nominal value 100. Bond is issued at 3%. This is 3% because there is no taxation is given. Conversion value is 115. We will discount 5, first discounting at 5%, then second discounting at 6%, and then we will calculate IRR, and that IRR is equal to cost of debt. Let's put the values here. Let's calculate the annuity factor at 5% and 6%, and that is equal to, so these are the annuity factor. And what about the discount factor? Here it is 4, discount factor is 0.784, and here it is 0.747. This will be equal to 4.329 into 3, that is 12.99. Here it is 115 into 0.784, that is equal to 90.16, and here it is equal to 4.212 into 3, 12.64, and this is equal to 85.91. The total of this is 3.15 and this is 1.45, and if we put the values here, lower rate is 5% plus lower rate NPV, that is 3.15, 3.15 minus plus 1.45 into 6 minus 5, so the answer is equal to 5.7%. So this is the correct answer, 5.7%. So how this will be calculated? Like this. Okay, let's move to the next part. In relation to the using dividend growth model to value Tulip company, which of the following statement is correct? The model assumes that all shareholders of the Tulip company have the same required rate of return. Yes, this is the correct answer, because we will have to assume that all shareholders will demand the same return. The model assumes a constant share price and a constant dividend growth for the Tulip company. Okay, share price can be changed, because if one of the variable is different, if one of the variable gets changed, share price can be different. So this is not a correct answer. Model assume that capital markets are semi-strong. No. Model assume that markets are perfect. This is not a correct answer. Model assume that Tulip company interim dividend is equal to the final dividend. No, there is no some such thing. So first statement is correct. Which of the following statements about equity finance is correct? Equity finance reserve represent cash. No, equity finance reserve means all the accrued earnings. It can be the cash earning, but it can be the accrued earning. This is not a right answer. Additional equity finance can be raised by right issue. Yes, but not with a bonus issue. Retained earnings are a source of equity finance. Yes, this is the correct statement. Equity finance includes both ordinary shares and preference share. No, this is not a right statement. So C is the correct answer. 20. Regarding Tulip Company interest in Islamic finance, whether the following statement are correct. Murabha could be used to meet Tulip Company financing need? No, because in the scenario it is clearly stated that company wants that type of financing which is equivalent to the equity, and that is Mudarba. Mudarba involves an investing partner. Yes, investing partner, the one who will invest only, and the other party who will manage. So second statement is correct.